Welcome to part 4 of our summary of One Up on Wall Street by Peter Lynch. In the last 3 episodes, we've explored Lynch's philosophy of investing in what you know, his 6 stock categories, how he finds and researches great companies. Now in this final part, we shift from technical to emotional mastery, the inner game of investing. Because as Lynch says, the key organ in your body for investing is your stomach, not your brain. Let's dive into his most important long-term lessons, psychological rules, and market truths, the things that separate great investors from average ones. 1. The most dangerous emotion: panic. Let's be honest. Investing is emotional. When the market crashes, our instincts scream, "Sell everything." When stocks skyrocket, we want to chase the winners. Peter Lynch says, don't. The real key to making money in stocks is not to get scared out of them. He explains that temporary losses are normal. Stocks will go down. The market will panic. Headlines will scream about recessions and crashes. But if the company you invested in is solid, ignore the noise. Lynch held on to some stocks that doubled, tripled, even went up 10 times. But only because he didn't sell too early. 2. Market timing doesn't work. Peter Lynch flat out rejects market timing. More money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. Why? Because no one can predict when the market will crash or rebound. Not analysts, not economists, not even Lynch himself. He reminds us that the best way to beat the market is to stay in it. Trying to jump in and out will almost always hurt your returns. The real winners hold on through booms and busts. 3. Ignore the economic forecasts. Wall Street is obsessed with predictions: inflation, interest rates, GDP. But Peter Lynch says, don't base your investment decisions on economic forecasts. If you spend more than 13 minutes analyzing economic and market forecasts, you've wasted 10 minutes. What matters is the business itself. Is it growing? Profitable? Does it have a strong future? You don't need to predict the economy to pick a winning stock. 4th, diversification. Not too much, not too little. Lynch believed in owning 10 to 30 great stocks. He warned against over-diversifying, or what he calls diversification, owning too many stocks and losing track of them. The goal isn't to own everything, it's to own what you understand. Each stock should have a clear reason to be in your portfolio, and you should be able to monitor and understand each one, its growth story, risks, and opportunities. 5. Patience is your superpower. Time is the greatest ally of any investor. Lynch stresses, you don't have to be right all the time. If you're terrific in this business, you're right 6 times out of 10. That's it. 6 out of 10. The key is that your winners outweigh your losers, especially if you find just one 10-bagger, a stock that goes up 10x or more. He reminds us that long-term patience is what allows compounding to work. If you constantly switch strategies or sell early, you'll interrupt the magic of time. 6. A simple checklist for every stock. Before buying any stock, Lynch would run through a simple mental checklist. Do I understand the business? Is it growing consistently? Is the company financially strong? Am I comfortable owning it for years? What could go wrong with this business? What is the story behind this stock? If he couldn't answer those questions confidently, he passed. This checklist helped him avoid impulsive decisions and stay focused on the long-term fundamentals. 7. The power of the individual investor. One of Lynch's boldest beliefs is that you don't need to be on Wall Street to succeed. In fact, he says you have an advantage if you're not. Why? Because you're not pressured by quarterly earnings, you're not judged by your performance every week, and you can act independently without following the herd. If you stay informed, stay patient, and stay rational, you can beat the professionals. Final words from Peter Lynch. Let's end with some of Lynch's most powerful quotes. Investing is fun, exciting, and dangerous if you don't do any work. The simpler it is, the better I like it. The person that turns over the most rocks wins the game. This book isn't about flashy trades or get-rich-quick schemes. It's about discipline, observation, and common sense. It's about treating stocks as ownership, not lottery tickets. And it's about staying focused while everyone else is distracted. So what's next? If you've watched all 4 parts of this series, you now understand how Peter Lynch thinks, how to categorize and research stocks, how to manage your emotions and strategy, and how to build wealth over time, not overnight. Be sure to like, comment, and subscribe for more legendary book breakdowns. And remember, use common sense, do your homework, and stay in the game.